helping you out. Signals that you can't hear. But we are live again on Tuesday Table Talks. I'm Pastor Sherman Bradley. This is
Pastor Sadell Bradley.
And we're coming to you tonight with a special guest who's going to help us tackle investments. His name is Marc Henn, and Marc is with Harvest Financial. Say hello, Marc.
Hey, hello, everybody.
Well, Marc, you are a CFP. Can you explain what a CFP is?
Sure. Certified Financial Planner, practitioner. So a CFP basically is somebody that has gone through a certain amount of education in the financial planning and investing realm. Actually, it took me about, a year and a half to 2 years to get that designation. But basically, that designation is there to give there was, in the financial planning world, there was no kind of set standard. So the CFP designation was created to provide that standard. So if a client or person wanted to know, did you have kind of a certain set of knowledge or skill level, that CFP designation would give them the comfort that we did. So, and it covers a broad array of areas.
How long have you been in this arena?
Almost 30 years.
Right.
A little gray on the side now showing up. So, yeah.
I would have never noticed.
We have qualified people on Tuesday Table Talks. Come on. And you're a Christ follower.
Yes, I am.
You're a friend of ours. And so the first question that we have for you is, what would you tell people who are anxious about their investments during the pandemic and the aftermath of it?
Well, it's been, if somebody watches the stock market, it's been obviously a crazy couple of months. And we had a very volatile market. In fact, the market from peak to bottom dropped about 37%, and did that in just a little over a month. Now, the stock market was created back in 1785, I think, something like, a long time ago. This is the fastest 30% plus drop we've ever had. So obviously the pandemic scared a lot of people and about the potential for that. But the market loves to react to things. It loves to react and then do an opposite reaction before you really think about it. And so there's an emotion to the market. I'll put some, some human qualities to it. And because of that, it feeds off of this fear and greed, and that occurs in investors. And so, what we really encourage people to look at is not to allow those emotions of fear or greed to dictate how they invest or how they think about investing. And we have a couple of things we can go through about how you can invest and remove those emotions of fear or greed, or to allow them to dictate for you. We'll talk about that in a little bit. But that's really kind of what's been going on. So in times, and we've had the last 10 years where the market's just been going up, up, and up. And I encourage people, don't get greedy when that happens, but then also don't get fearful. I think I shared with you, and I've shared this with a lot of people, that when things go on sale at a store, that usually attracts people to those things to purchase them. When the stock market goes on sale, when things go down in price, that's about one of the only places I know of where people tend to run away from it because there's fear there. But the way I see it is that things are on sale. So it attracts me to those things. I want to purchase those things when they go on sale, even though it may not feel very good at the time. That's usually the best time. JP Morgan, there's a bank, JP Morgan, but there actually was a real person, JP Morgan, had a fairly crude statement where he said, I want to buy investments when there's blood in the streets. He wants to buy things when it gets really, really bad. So don't allow those emotions to dictate how you're going to invest, even in these times.
So if someone is feeling fear about their stock portfolio going down, you're advising them to just stay steady and hold on. I know some people, I think the government allowed there not to be a tax or extra fee if you take your 401k or something out currently. Is that correct?
Well, they definitely have passed some emergency measures to allow people to access cash if they need to, out of their individual retirement accounts, let's say out of retirement accounts. Without getting into all the details behind it, we typically would encourage people not to do that if they don't have to. And the reason being is because usually when you go in to get that money, it usually doesn't go back in. It finds a way. It's kind of like when your kids ask for money, right? You're going to loan money to your kids. If you really think about it, you're not going to get that money back, right? In most situations. That's the same thing with these retirement accounts. We encourage you to continue to invest. And so I'm not saying it's not, I'm not saying that you should be happy when we go through this. Obviously, it can be a trying time, but one of the ways to help secure yourself is to make sure that you actually have, and I know in the past couple of guests that you've had, you talked about having that emergency savings account already built up. So 3 to 6 months worth of that emergency cash that's already built up that you can access if you need to. That way you don't have to go in and access the cash that are in your investments, because you want to allow those to continue to ride and potentially add more to them when you can. If you don't have any emergency cash and you get in a situation where the market's down and then you have to pull it out, now you're selling at the wrong time. You're selling when we actually want to buy things. So first rule of thumb is to have that emergency cash set aside 3 to 6 months worth of protection there so you can get through this. Now, you may stop saving. So obviously what we're going to encourage is for you to save over time and to save consistently. And that term is called dollar cost averaging, where you continue to put money in. And so when the market goes down, you're buying things at cheaper prices. If the market's up, you can feel good because your investments are up. But it's a consistent approach of investing that allows you to kind of smooth out those ups and downs, so you don't have to worry about the big gyrations, because you're kind of smoothing it out. You're getting things at cheaper prices, and that'll help average things out. But having that cash set aside already for emergencies will help protect your ability to invest and not have to tap into those investments at the wrong time.
So if you are a novice at this, there are people with varying degrees that will be listening. How do you begin to invest? Let's say you've already got 3 months of savings for your emergency, and now you want to begin to put some money in the stock market. How do you do that?
So there's probably multiple answers to this, but I'll start out by saying you really need to determine if you recognize, okay, I want to invest. You really have to kind of check yourself and say, am I the kind of person that wants to spend a lot of time researching my investments and where I want to then maybe buy individual stocks? Or do I want to use some other investment vehicles that can allow someone else to do it for me, or at least I can what's called diversify, which means you get rid of, if I buy one stock and put all my money in one stock, if something bad were to happen to that company, it would dramatically impact your investment because you're not diversified. You want to spread it out amongst many areas. So if you're not going to do your research to spread it out amongst many areas, there are a couple different investment vehicles you can use to help do that. That's the first thing. The second thing, and we'll come back to that, the second thing is to recognize, where can I invest? And that's the second thing you realize that. And the first thing I usually tell people to look at is that if you're employed and you're working for a company and they have a retirement plan, you really want to look into their retirement plan, like a 401k or 403b, that allows you to contribute money if you have that kind of plan. And within that plan, they will have investment options. But there's some tax benefits you can get to that. And in addition to that, you want to see if your employer will put money in for you or match it. So you wind up getting free money out of that as well. So that's where you want to start. We can go into that a little more in detail, but that's kind of the 30,000-foot view of, what kind of investor do you want to be? And we can talk about that. And where do you want to invest? And you want to start with retirement plans at your work. And if you don't have one of those, we can talk about some other areas, but those are the couple of places that you want to start.
So some companies have a profit sharing. So maybe a company like P&G, how well the company goes, they give a portion of their retirement in stock to their employees. And as the company continues to grow and they have shares of it, they are incentivized and happy. And when it splits, it gets more and more money. Some have an entry point that is kind of like you're talking about the defined contribution plan. And you would go to your HR person. Who would you go to within the company to sign up for this?
Yeah, it's a great question. So there's going to be your human resources department if you're in a larger company. If it's a smaller company, probably some officer of the company there will have information about the plan. And then they may have another company that actually runs the plan, but they'll be able to get you to the right place. And most companies these days have these defined contribution plans, and that's just a term, but most people are maybe familiar with 401k, 403b profit sharing, something like that. But there's multiple ways that the company can benefit you. As you put money into that plan, they may do something called a match, where they're going to match that contribution and put so much in on your behalf. They may, if you're a part of the plan, they may be required to put money in that's called, and again, you have to remember this, what's called a safe harbor contribution no matter what. They may have a profit sharing plan that you mentioned, Sadell, where if the company does well, they may put additional profit into it. If they didn't do well, they don't have to, but it's a benefit there for you. So I really encourage people to check with your HR department, see if you can get involved in that. As you contribute to that plan, that money in traditional type plans actually will come off of your income, and you will pay less income tax on that. Now, there are things called Roth 401ks and things like that that work differently, but traditionally, that's one way to lower your taxes as well, is to buy you save money, you get all of that savings. The company may put money in for you, and you're going to pay less taxes right now. Now, you'll wind up paying taxes on that way down the road when you pull it out, but what a great way to take money that you would have had to pay to the government. You get to keep it for yourself for now and get to make earnings on that until at a much later date. That's the power of those defined contribution plans.
And there's some of your larger nonprofits that also have the 403Bs or profit sharing opportunities. So it's great to ask. Oh, hopefully, when you were hired, your HR department or the HR representative shared that information with you. But if you did not know, and they did share it with you, and now you're learning, this is something you definitely want to go back to them and ask them further questions on how can you take advantage of such.
And all those different numbers, those all work the same way. So we're just referencing different defined contribution plans that all work the same way. Again, 401k, 403b, 457, so all these numbers, but they're all defined contribution plans, and they will all work the same way.
So, if we backtrack historically, our parents and grandparents used to work for one company 25 years, 35 years. They would retire. They would get a pension for the rest of their lives. And that was the company paying into stocks for their employees.
Correct.
And probably around 15, how many, 20 years ago?
Starting about 20, 25 years ago, what companies realized is this is becoming a larger financial burden for the company. People were living longer. As you have to understand how these pension plans work, right? So the company puts money in for you, it's in your name, and when you retire, the company is going to take care of you by giving you this monthly pension until you pass away. But there are certain things that go into the calculation of these benefits. And as people are living longer, that's a higher cost to the company. As interest rates go lower, so interest rates have been going lower for the past 30 years, that's a higher cost to the company. So the companies were looking, how do I get away from those types of plans and take care of the employees that way? And a way to do that is they shifted to these defined contribution plans and really put the burden on the employee now as opposed to the employer. So you're exactly right.
So really what we're saying is that it used to be that a company would take care of you and that we would work for companies for 25 years. Now people are only working 3 to 5 years for a company. And so now we are all responsible for our retirement and how much we have when it comes out that we are 65, 75.
Yeah, I really think this is a time period where you really need to take ownership of yourself. And I don't mean this in a bad way, but not to trust in the company to take care of you. You really have to, you need to trust in you and the work you're going to doing and what you can do, the people around you as well that are going to support you as well. not necessarily look to the company to provide. You know, in the 1950s and 60s and 70s, especially, you know, auto manufacturers, steel companies, that's where you found a lot of these big pensions, and those just aren't there. You know, in the last, in 2000 through 2002, you had a lot of issues there as well. And so what companies would do is they would just barely fund their pension because they're trying to show as much profit as they can. And then the stock market goes down, and all of a sudden it's like, oh no, you know, we have to put more money into the pension, and do we have that there? And so there's a lot of pensions that are still out there that are underfunded. If you even remember back in the Great Recession, 08 and 09, you know, General Motors, they had a pension they were paying to their employees. They had to go through bankruptcy, and so if you were getting a pension, you may only be getting half of what you were getting before for that.
Speaking of underfunded,
yeah,
talk about Social Security, because what I'm trying to do is build a case, for like what I said, for why we all need to be investing.
Right.
So, Social Security.
I think there is a trend where for many years, this was especially true with the baby boomer generation. There was a long period of time where they just looked to the government. The government's going to take care of us. And then what started happening is, as these baby boomers got older, they got to about age 50, and they realized, hey, wait a second, Social Security is underfunded, my pension's underfunded, or they're going to get rid of it and so forth. And they realized, oh my goodness, I got to play catch up now. And so this shift has been going on again for about the past 25 years, where this shift of, I'm going to let the government and company take care of me, and I need to take care of myself. So Social Security, you know, it's a system where you put money into that system, but the government itself has passed laws to allow the government to tap into those resources, which makes Social Security somewhat then underfunded because of that. So what will happen is they will address this at some point in time. So right now, it's fully solvent, I think, up through 2030 something, 2034, 2036, something like that. It doesn't mean it goes completely under at that point in time, but what will happen is, you know, the laws around Social Security have changed since it was created. And so a new set of laws will come into place. So for instance, you know, it wasn't that long ago where the maximum retirement age was 65. Well, now it's 67, right? They may take that retirement age up to 69 or 70. They may look at your income and say, well, if you earn so much income, we're going to tax your Social Security benefits. And you might say, well, I put that money in, why are you going to tax me for it? And the answer is going to be, well, because we're running short. That's the answer, right? And so the government's always trying to play this game of how do we play catch up on these things, but how do we tap into resources? And of course, you can look at the budget, you can look at the debt, the national debt we have, which is, you know, $20+ trillion in this country, and see that the government's looking to find ways to find money. Yeah. And so they tap into Social Security. So
that when it comes to
military.
Yeah.
So let's say somebody's watching, they're a novice. They don't work for a company that is actually matching. They don't have a 401k or 403b. Or maybe they have one, they're only matching a particular amount and they're behind, and they want to know, what is my first step in learning more so I can be more proactive? Where do I go?
Well, I think the first thing you need to do is step back and look at your finances to begin with. You need to really control your budget and not let your budget control you. So if you know, I know, again, going back, I've loved the sessions you've had on the past here where build up those savings, look at where the money's being spent, where can you find that money to save? And I think you really need to look at how do you take care of yourself first? So as your income comes in, you know, I would suggest tithing. I think tithing is very important. After that, how do you pay yourself? That's good. How do you pay yourself first? And what I mean by that is not pay your bills, but you really need to look at your budget to how you can find those resources to be able to save and invest for yourself. Maybe even 10% of your pay to be able to put away for a long term. And if you look at long-term saving and investing, there's real power in that to start early and to continue to invest. So if you can do that from an early age, then you find in your budget, how do I find that money? And you need to look for it. And we don't have to go through a big budget thing right now, but there are tools out there that you can use to say, look, you should only be spending this much money in this area, or only spending this much money in this area, and let the budget help you direct that, as opposed to you saying, well, I'm spending 50% on housing. I can tell you that's too much. And so you may have to make an adjustment. You're not going to find 10% for savings if you're spending that much on housing. So find that money that you can invest. And then if you have the retirement plan at work, that's great. If you don't, then, and for people that do invest in the retirement plan, if they have more they want to invest, then you can actually open up retirement accounts individually. They're called individual retirement accounts, IRA accounts. You can put several $1,000s into that, $6,500, I believe, for this year. And there's a lot of numbers up here. And then if you're over 50, you can add another $1,000 to that as well. So that's a lot of money you can put away. And these individual retirement accounts can be opened up at just a brokerage firm like Charles Schwab and Company, Fidelity, even Vanguard. There's different places you can open these accounts. And then as you contribute that money into it, you can even connect your bank account to it. So you just directly invest. You can move money over into it overnight and move it into the account very securely, very safely. And then you can invest that money, again, into some of these other vehicles, which we'll talk about here in a little bit. But that's a way to start saving. If you fully fund that, then you can open up just what's called a brokerage account, where it's just an account in your name. It's like having a savings account at a bank, but you're going to have this account where you can invest into securities, into stocks, mutual funds, exchange traded funds, different things that you can invest and hopefully watch that grow as well. And that would be an account just in your name or a joint name, something like that. So there's multiple types of accounts you can open to do this beyond just the company retirement account.
So tracking back for those, this is Sadell and Sherman Bradley from the Warehouse Church. We're here with Marc Henn, who's a certified financial planner, and he is talking to us about the things that we need to know about investing. First thing that he said was that in this time of the pandemic, that we should not be overly emotional about our decision making, that if at all possible, if you have money in your retirement accounts or investments, that you should keep them there. If you are new to investing and you have not yet ever started, the first thing to be prepared is to have an emergency fund of 3 months of expenses, or 3 to 6 months of expenses, to secure yourself, so that once you put your money into a retirement account, you don't have to pull it in, take it out, and put yourself at more financial risks. And then he said that you need to check with your employer to find out if your employer has a 403B or 401k account, some kind of retirement plan,
right,
particularly if they are matching funds. And that means that they're giving you free money. Basically, you put in 3% and they will match it another 3% and then watch it grow in the stock market. And then he said, you can also open your own retirement account. And you can put up to $6,500 a year in that account. If you're over 50, you can spend another $1,000. And then you can go even further than that after you do all those things. I'm sure people are like, come on now.
That's right.
Then you could actually do all of those things. And then afterwards, still, if you wanted to leave a legacy for your children and grandchildren, you could open a brokerage account and direct monies to that, to even increase your security going forward.
It's really you taking control of your investments, your future, and so forth, again, as opposed to trusting or depending upon something else that probably is not that dependable anymore. So
we just saw The Last Dance. It was great. The Last Dance was 10 weeks of pure joy for anybody that's a basketball fan and is missing the NBA. And we really saw a person that was very focused on a particular goal and was ready to make themselves the best, knew where they wanted to end up. We saw somebody very young retire twice.
Right.
So this idea of retiring and not being broke when you retire. One of the things that when you go to someone like yourself or someone in your HR department, you're going to say, hello, I'm 40 years old. and my target date for retirement is 65. So I have 25 years, and I want to make sure at the end of that target, I have what I need.
Right.
How does that conversation, how does that go? What are you thinking that we need to know?
So there's a couple things. One, I will tell you that there's a lot, if you get online, there's a lot of online tools that you can go to Vanguard.com, any of the places, Schwab.com, Fidelity, even probably if you have a provider at your work, if there's another company providing the retirement plan, all of these will have tools that you can go in and even put this information in there, and it will give you a rough estimate of, well, if I put this much money in over this many years and I have this kind of growth rate, what will I have at the end of these 25 years or 40 years or 10 years? Some of them may be able to do it in reverse, where you say, well, I need to have in retirement, I know I'm going to get this much in Social Security. I'm going to get $1,000 in Social Security. I want another $1,500 a month as well, or whatever that is. You may be able to put that in there, and it'll tell you how much you need to save over the next 25 years to be able to give you that $1,500 a month as well. So those are online tools. I will tell you the biggest thing is, I referenced that in when you invest into like real estate, there's three things you look for. And the joke is it's location, location, location. And so when I talk about investing, the three biggest things are save, 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 and early, early, early. So the earlier you start and start saving, and the key word here is discipline, going back to Michael Jordan and the thing. There was a discipline there that he had. It didn't come easy. He had to work at it continuously, right? This is something you have to work at. You have to be disciplined to want to save, but the rewards are tremendous. At least historically they have been, if you do this. So you can actually start, if you're 18, 19, 20, and you start saving at least a couple of $1,000s a year and more if you can. If you can do that consistently every single year, you'd be amazed what you would have at age 65. And even if you look at the average return in the stock market, if you saved let's say $3,000 or $4,000 a year, you would have well over $1 million at age 65. Well over. And people don't realize the magic of compounding. We've talked about this before. The magic of compounding on the other side of high interest rate loans, and how the interest is so high when you get trapped into those things. Well, the benefit on this is that you get a reward of that when you start investing. You get to take advantage of that as opposed to someone taking advantage of you when it comes to investing and that compounded interest. So those are the key things: discipline, save, and early.
So yeah, interest is a really strong thing. You found that out when you had your credit card, and your credit card was 18%, was 24%, and you paid $100 some for a $20 shirt that you thought was on sale.
Right.
So it works in the reverse to the negative, but it works positively in investments.
I remember even Albert Einstein was confounded by the magical power of compounding interest, and how dollars will compound on themselves and continue to grow. He couldn't even understand that. It was just, but there's nothing mystical about it. It's just how numbers work and how compounding works, and it's a powerful tool.
So we're seeing oil prices, stock markets going down, it's fluctuating. And you said that when it's a bear market like this is the good time. Stocks are cheap. This is the time to get into stocks. If I were a last dance kind of person and I wanted to buy Nike because I really like Jordan, how can I go about that? I've heard about Acorns. I've heard about other places. What is the best way to actually go and purchase if you wanted to buy a single stock of something that you use all the time, like Warren Buffett, or something that you like?
Yeah. So first of all, I need to recognize that the two biggest expenses when it comes to investing is taxes, and then also fees. And so you have to know what's going on there. When it comes to individual stocks, a lot of places now, the Schwabs, the Fidelities, things like that, don't even charge a fee anymore to buy or sell a stock, which is amazing. It's just the cost of that has become commoditized. They make money different ways, but no more on these transactions. Things like where you can, the apps where you can go and Acorn and so forth, and then, add $10 here or something like that. You really need to look, because I think for most of those, and I'm not fully versed on those, but I'm almost certain that with all those, if some of them, if you're in college, they allow you to do it for free, but a lot of those really, they will charge fees on that for you to do it. And those fees can be fairly high from a percentage standpoint if you're putting in $5 or $7 or something like that as well. So just be aware of that. You can open accounts and buy stocks at Schwab's or Fidelity's, or again, Vanguard's, places like that. But I mean, one, how you go about doing it is you just open the account and you put the money in there, and then you can go out and buy these shares of stock, and the price is trading at a certain price. Let's say maybe it's trading at $50 a share. So you have to have at least increments of $50 to buy one share of stock. And the issue though is that, I would always encourage people, they need to research the names. If you want to own something just because you buy it a lot and so forth, I think that's okay. But for the predominant amount of your portfolio of how you're going to invest, if you're not going to research, then you really need to use some of these other vehicles like mutual funds and exchange traded funds to do your investing. And I will point out, retirement plans like the 401ks, the 403bs, things like that, a lot of those plans will not allow you to buy individual stocks. You have to purchase mutual funds as the only investment type vehicle that are in those plans.
I have a question here from David. It says that real estate has long since been one of the most lucrative investment options. In light of the current economic environment, how do you view and advise a potential investor regarding real estate investment trusts? And in what increments would you advise a potential investor to consider as an entry point? Is this a wise option for an investment? What safeguards or concerns might you have about REITs?
So great question. Real estate has been investment real estate has been one good area that you could invest. I always tell people that if you're not, a lot of money has been made from people investing in investment real estate or real estate development. And so a lot of people become very wealthy off of that. So a real estate investment trust is a way to invest into real estate where you may have direct ownership of the real estate, or you may own shares of a company that owns the real estate. So it depends on how it's set up. But you have to recognize there are multiple ways to buy real estate investment trusts. And I just want to caution you, when you think about the different people you can go to for advice, there are stockbrokers out there, there are insurance agents. They work on the commission-based model where they're going to sell you something, there's going to be a commission associated with it. That's how they make money. My firm, Harvest Financial, works on the fee-only side of the spectrum, where we help clients invest their money, but we don't sell any investment products. We're actually investing the money for them to build a good portfolio for the long term and help them through that process as well. And we charge a fee to do that, so we're not selling anything. When you talk about real estate investment trusts, there are certain real estate investment trusts that brokers and things like that will sell to you that have very high commissions associated with them, like maybe 7%, extremely high. And those real estate investment trusts are not publicly traded as well, so it's difficult to get out of them. Mm-hmm. So you need to recognize that may not be the type of real estate investment trust you want. There are other real estate investment trusts that are traded on the stock market, just like you might buy Nike stock that you referenced earlier. There's a stock you can buy. There's real estate investment trusts you can buy. Some of them will be invested into apartment buildings. Some of them may be invested into cell towers, because cell towers lease businesses. Some may be invested into leasing computer space. That's a real estate investment as well. So you really need to look at what type of real estate investment trust you want. I think all that to say, one, be careful what kind of real estate investment trust you're getting into and always look at the fees. But two, I think real estate can be a great part of a portfolio, but I would not put all of my money into a real estate investment trust. I would use it as a portion of my overall diversified portfolio.
Okay, we have a question here that says, I heard in the news that due to the economic downturn, most future retirees will be living off of $35,000 per year. Middle-aged persons starting now saving for retirement won't be able to save enough to live above the poverty level when they do. And now we know that only a third of the US population doesn't have anything saved for retirement.
Right.
So is this something that is of concern for lots of people, that the economic downturn is causing a lot of problems for people who are middle-aged?
I think for me, the concern is more so two things. One, the sensationalism in the media would be one, and two, the lack of savings that is going on. So one, we do have a real savings crisis in this country where people look to spend, and they say they can't find money to save. And I'm telling you, that's where you have to be diligent and disciplined. You have to find it and take control of it for yourself. You have to do that. That's where a lot of people were falling short. And yes, there will be difficulty there. Will the government be there to take care of them with Social Security? We hope so, but we don't know what that's going to look like. So you really need to take control of that and save for yourself. The second thing is sensationalism in the news. The news, you have to remember, is there to sell subscribers. They want people to watch. If it's a magazine, they want people to subscribe to the magazine, whether it's online or not. So they will use that same fear and greed to motivate you to watch or pay attention to what they're reporting. So remember we were talking about when the market's down. And so what they will do is they will take that point in time when the market is down and say, all this wealth's been wiped away. And now because that's happened, all these people now are going to have less to live on. They will pick a point in time to do that. And so I would caution you not to do that, because there will be points in time. We could do it when the market's really high as well, and that would not necessarily be appropriate either. Mm-hmm. So you just have to be careful of that. And so I would say this is where you have to take ownership of yourself and to support those around you. Don't let those news stories dictate how you're going to invest. Again, take control for yourself, to have that disciplined approach and do it. And historically speaking, it won't matter the ups and downs that we go through. It just won't. Because by the time you retire, what you'd wind up doing is structuring the portfolio such that it won't necessarily all be invested into equities or stocks. You'd have a portfolio that would be less volatile than that you can live off of. And if the market goes down, the portfolio does not go down near as much. If the market goes up, it may not go up as much, but that's okay because you're shifting into a different mode now. You're shifting into needing cash flow from the portfolio as opposed to putting it in. So you would make those adjustments at that time. So I would just caution you, I wouldn't allow that fear to overwhelm you in terms of what they're reporting. You take control and do it yourself, and you won't have to worry about that.
So we have another question here. When you have lost a job and all your assets and you're in your late 50s, what is the best way and the quickest way to rebuild for retirement?
So, and I can definitely feel for the person that asked that question. I think there's probably a fair amount of people in that situation. And so from one reason or another, maybe they weren't able to save, or if they did, now they spent down those assets and they've lost their job. So one of the things, I guess the hard answer to that is that there's no quick way to get that back. And if you're looking for the stock market to provide a quick return on that, it will disappoint you. That's not the place to do that. And so, what I tell people in that situation is, first of all, I want to walk alongside them. I want to have a support that walks alongside them as well. But they're going to need to really take a look and say, you know what can I start saving again? Or I need to go out and find this job. Where can I get that? Am I getting the support I need right now to make sure I'm taking care of myself? That's the most important thing. And to create a budget and a plan going forward of what that's going to look like. And it may take 6 months or a year before that plays out. It may be that, I used to drive this car and now I have to get a cheaper used car. There may be places you have to cut. And so it's a hard answer, but it's the right answer that you're going to have to wind up looking how you can look at it. And you might have thought, okay, I'm going to stop working at age 60 or 62. It may be now that you have to work to age 65 or 70 if you can. And recognize this: the longer you work, then and you're saving before you have to tap into Social Security, if it you'll get a higher amount by waiting to be able to take it later. So even if you start working and you don't believe that you can save, or you can't save that much, by delaying taking your Social Security until later, you will get a higher dollar amount from Social Security, and that's a benefit you want to maybe postpone if you can as well, if you don't have a large amount of savings to tap into.
How about a person saying, right now I have a house, I own my house, or I'm renting, but maybe I should be looking at a property and maybe having a duplex, live in one part, have another person live, and have the passive income that pays my mortgage and continues to give me money later on. What are your thoughts about that?
I think that's a great way if you're willing to. I think the stories and the fear of the midnight calls because the toilet's overflowing from your tenant next door are probably overblown, but you need to recognize that you will have to put some time and energy into it. And are you going to put that time and energy into it, or are you going to pay someone else to do it? So you really need to look at those numbers before you do something like that. And if you have the resources or the cash flow to pay somebody, or you have the tenacity or the ability to do the work aspect of it, I think that's a great way to build wealth in real estate as a part of your portfolio. I don't have a problem with that at all. I think that one of the things that I have a concern about in this country, anywhere I guess, is a personal residence, your home being an asset. It is, but you have to be careful of that, because that asset, that home, one definition I like of an asset is that in most situations I want it to pay me some sort of cash flow. I want it to give me something. And a home doesn't give you any cash flow. It takes from you real estate taxes, fix-up costs, all those ownership costs, things like that. So I'm not telling you don't own a home, but don't go crazy. And I've known some people in the past that will not do any savings, and they'll buy a bigger home because they see that as an asset. And that's where they're going to put the money for their asset. I just caution you about that strategy. I like differing strategies. So have your home as an asset for what it is, but maybe make that a little bit smaller, be able to have some cash to invest in other places as well, and diversify your investments.
If we go back to the beginning where we're talking about the pandemic.
Okay.
And, 2009, Sherman talks about all the time, the $7.7 trillion was used to bail out the banks. Mm-hmm. Now we've had another stimulus package that has happened for larger businesses mostly. And then we've had, the stimulus checks that have come to individuals. What does all that mean for the stock market and for regular people? So
that's a multi-tiered answer that I will boil down here. So you can see them, if you watch the stock market, you saw the reaction that it had. That's why it dropped so quickly, because of the fear of the unknown. And the market doesn't like unknown things. So in my job, one of the things I have to do is try to quantify, try to figure out, am I going to get paid for the risk that I'm going to take? Mm. And the market was saying, we can't figure that out. And so it just went straight down. Mm. When it got to a certain point, it got so cheap, money started coming back in, or the market started thinking, and I say the market because it does kind of act as its own kind of creature, started thinking, well, they'll figure this out. So it started moving back up again. So the fear in the market is not so much about the virus itself. It's about the response of government officials of what they're going to do. So in my work, I will tell you this. This is not to discount the pain or anguish anyone's gone through of someone they know that's had this sickness, if they've had it, or even someone that's passed away. I very much feel for that. Economically speaking, though, if you don't reopen things, it would be very catastrophic for the economy and the stock market as well. So if you start opening things up again, and in the news, you're going to start, I just saw that in Montana, it was reported that the death cases have doubled there. So it might have been CNN or something like that, put that state in red as like really critical. Well, it did double. It went from 1 to 2. So there's misinformation that's going out there to create that fear for you to stay watching. If that kind of stuff creates fear in government leaders and they decide to start shutting things down again, that would not be a very good thing for the stock market. It would not be healthy at all, and we probably would see it go back down again. We have to realize that there are real risks that come with not starting the economy. There's a study that was done, and I forget the name of the book. I'm happy to provide it if anybody wants it. But they noted that if unemployment goes up by 1%, that they were able to calculate, that equates to about 33,000, it was either 33 or 37,000 deaths in this country. So if you don't reopen things and you have this long-term high unemployment, let's say of 15%, well, that's a 10% increase from where it was at. That's about 350,000 deaths approximately that we would get annually from having that higher unemployment. So there are things on the other side, because you have people that are hungry, that aren't working. You have worse, so they're not taking care of themselves. You have increased violence, increased domestic abuse, increased child abuse. All those things come along with higher systemic or a system of high unemployment. So that's not being talked about a lot. You have to recognize those things are on the other side. So I think we can be concerned about people having the virus, but we also need to recognize that we need to open the economy, not just for capitalism's sake, but for our own sake as well. We need the economy working so we can take care of ourselves as well. So I don't know if that helps answer the question, or if I went off on a tangent, but I think it's important to recognize the other side of not opening up the economy as well.
Yeah, that's very interesting. Too many thoughts go through my head that we can't get a discussion from that statement. Maybe we'll afterwards.
Maybe we can talk about that offline afterwards.
Yeah. There's another question that says, is a financial planner good for everyone? And how can one help to build wealth?
So again, I think I will say this, for most people in this country, that's going to come, how to build wealth is going to come from you saving. I mean, that's the key thing. It's so simple. It doesn't have to be complicated. It's very simple, but it's disciplined as well. Is a financial planning needed for everybody? Not necessarily, because you can take ownership of this yourself. So again, let's go back to the point of you having a company retirement plan. If you have the company retirement plan, if you start saving, if you're younger and you start saving 10% of your income into that plan, and there's a match as well, and you have a good investment strategy in that, you probably don't need a financial planner for a long time when it comes to that, because you're doing what you need to do. Now, when it builds and grows, and let's say you started this when you were 25 and now you're 45 or 50 and it's really grown, I think you may want to engage a financial planner before you get a year away from retirement. But now if you're 15 years away from retiring, that may be a great time to engage a financial planner. So, it may be difficult if you're just starting out and you say, well, I'm going to start putting in, $100 a paycheck into my 401k. There's not a whole lot of financial planners going to be able to do for you except tell you that's a great job. And then they're going to charge you a fee to tell you to do that. So you don't really need to do that until you get to a point where you're building that up. So again, take charge yourself at first, engage the financial planner later as it gets to a point where it's so large you feel uncomfortable, or you recognize that I've been doing this now for 20 years. Maybe I need to start engaging a planner to help with that.
I'd like it to be so large that I feel uncomfortable.
Okay.
Generally, I mean, if we had to put, as I'm looking at the figures, I've seen some banks, there's only about 8% of the population whose retirement portfolio is over $300,000.
It's probably true.
So when you go, over into your six-figure kind of world, then it's probably time when you start maybe thinking about consulting someone. And I've started off with six figures and I can go into the next 15 or 20 years to retire. Maybe that is
Yes, and recognize different financial planners do things differently. So some will maybe just put together a plan for you, and that's and they'll do that and they'll charge you a fee, and that may be very helpful. Other advisors maybe only offer comprehensive services. So they want to do everything soup to nuts and provide a lot of services for you, but to do that, they may require that you have at a certain asset level because of the amount of work they're going to put into it. So it's not that they are don't necessarily want your business. It's just that their model is such that they're providing a lot of service. That may be somebody to engage as it gets even larger after you've engaged maybe a financial planner to put together a plan for you. Maybe you continue to work and save at that as well. Then you can shift to another advisor that may, they may use the term wealth manager, where they're going to provide all kinds of services: tax advice, estate planning advice, retirement and cash flow planning advice, and they'll do the investments for you, a whole picture. But typically they're looking for clients to have a higher asset size as well. But there are people all along the way. Just remember, you want to check to see what kind of fees, especially if it's a commission-based type advisor. You really want to understand what the fees are. What are the fees inside of it? They work on what's called the suitability standard, not a fiduciary standard, so it's a lower standard of care. They don't have to disclose all the fees to you. All they have to do is give you a big, large booklet called a prospectus when you invest. That's if you invest into like mutual funds or things like that. If you buy an individual stock, that's a different story. You pay the fee to buy it if there is one, or you don't, and that's it. So there's that prospectus, and inside of that is all the fees and the commissions they make and so forth. You have to do some digging yourself to understand that. But there's a lot of ways to invest, again, where you don't have to use that brokered type of approach. And I just want to briefly I mentioned mutual funds and ETFs. I just want to briefly explain what that is. A mutual fund and an exchange traded fund both are diversified ways to purchase individual stocks. There can be fixed income or bonds as well, but we're just going to talk about stocks for a minute. So you can go out and buy shares of publicly traded companies like Apple, Nike, IBM, Visa. You can buy those individual stocks, or you can go to somebody who has a mutual fund, and there's probably 35 or 40,000 mutual funds out there, and probably 5,000 exchange traded funds that are out there. And what those are is you put money into that one fund, and that fund managers are going to invest that money over a broad range of stocks for you, so you don't have to pick the stocks that you want to invest into. So the benefit is you don't have to worry about trying to figure out which stock you want to invest into. You just know you want to invest, and you're going to put your money into that. Now, there will be a fee for that. The manager will charge a fee, but that can be a great way to do that. And there are some ways to invest where there's very little fees with what are called passive or exchange type funds, where no one's actively managing it. It just represents a certain basket of stocks, and that's just what it stays at. Those are typically called like index funds. Then there's other mutual funds where they will buy things for you, and they'll make changes and so forth. And those fees typically range for large cap U.S. companies. You can find a lot of large cap U.S. mutual funds, and you're looking at fees of 0.6 to 0.8%, probably 0.9%, 1% that are in there for those types of investments. The more aggressive types of funds, if you've done the Dave Ramsey course, he talks about doing international investing and more aggressive or small cap type stocks. Those mutual funds typically have higher fees, maybe 1.5%, and they're inside the fund. But those are ways to be able to invest where you don't have to worry about trying to pick the stocks. You're just not worried, but you're focused on saving the money and investing.
So sometimes, when you start getting technical, it's like, I
know.
So here's a question, and because we're getting closer to the end. Here's the pandemic. The way that business is being done is going to change.
Yes.
For lots of people. There are probably industries or companies that will be faring much better. And I guess it's part of your job to figure out which industries and what companies.
Yes.
How does a person know that one? And then my second question is more of an academic one. We know that Warren Buffett has a book. We know that Dave Ramsey has a course.
Right.
If someone really wanted to get, Investing for Idiots or whatever, something that what would you recommend for people to understand? So the first question is about what industries are going to be really impacted. And then the second one is, what resources do you recommend online or books?
So first of all, I'll take that last question first. There's a couple of books I can recommend and I want to get the names correct. There's ones like A Random Walk Down Wall Street and so forth. I want to get the names and the authors as well. And so if I can, I'm happy just to email those to you and then you can post those up there. I want to make sure I get a good list there as well. There's 3 or 4 I probably would recommend. And then, what was your first question again?
The business life has changed because of the pandemic.
Oh, yes. Thank you.
So businesses, we know Amazon is kicking butt and taking names.
Right. I think, again, it comes down to the time and energy you want to put into it, right? So that's our job. That's part of our job, is to figure that out. So I can look out and say, okay, one area that's dramatically going to change is the energy sector. Let's say that. There's probably a lot of energy companies with the low price of oil that probably are not going to make it. So if I want to invest into energy, in traditional types of energy, what companies should I invest into? Well, I need to put my research into that and figure that out, right? And it takes time. As we look at changing trends, we have to look to see what trends are there and what trends may hold and what trends may not last, and then project, if this trend happens, well, how could it impact, an industry we're not even thinking about, down the road. So you have to think, you almost have to think multiple trends ahead to figure out how this is going to play out. And so we have to spend time doing that. So if you want to spend the time doing that, yes, that's a great way to invest and take advantage of some of those things. You mentioned Amazon. Yes, we've seen Amazon get a lot of benefit out of this. We've seen stores like Costco get a big benefit out of this. Home Depot. Pardon me? Kroger. So things that might be more needed. If people are going to cook more at home and they don't go back to the restaurants, does that trend continue or not? And who would that benefit? Would that benefit spice makers because people are going to spice their food more? So there's all kinds of things you can think about how that may play out. And so that's what we have to do. So that's my point. If you want to put the time and energy into it, yes, I think you can get a true advantage out of that. But it can wind up being a full-time job, which is why we do it full-time. And so, and if you don't have the time, that's why instead of doing individual stocks, sometimes those funds and things can be a great way to do it, and invest with people who do it full-time as well.
Here's a question, and this will be the last one, I think. What's your perspective on Christians and how they interact with investing?
That's a very good question. I think that here's the way I see it. I do believe that there are some Christians that see the stock market as gambling. So, I'm not necessarily in favor of gambling, but I don't see the stock market that way, and I'll explain briefly here in just a second. But if you believe it is, and my answer I'm about to give doesn't change, then I think that's fine. You might have to find a different way to invest through real estate, other things that you don't see it as gambling. So I think that's fine. All the stock market is, if you could go and invest into a private company and have ownership of that company and benefit as the company does better and take the lumps if it does worse, I don't think people would see that as gambling. They would see that as I'm investing in a company just like I'm investing in real estate. The stock market is what's called a secondary market. Once a company has been formed and it grows, it decides to issue ownership of that company. And that's what you're buying in the stock market. You're buying ownership of that company. And so it's just another way for people to get ownership of public companies as opposed to private companies. The difference is the market also works on emotion. So you get those gyrations, and that's where people come up when they think about, oh, this is kind of like gambling because you put your money in it could just go down. Well, yes, the market does work on emotions, and that's why I'm saying it's important to remove those emotions from how you invest and to recognize the market's going to respond that way. But that does not mean that the companies you're investing into are doing poorly. they could be doing very well. So for instance, one of the things I may look for, like in 08 and 09 when we had the Great Recession, companies I may want to invest into, what are companies that their stock price might even have gone down, but their earnings were still going higher, they were still performing well. Those are companies I want to invest into, and you may be able to pick them up at cheaper prices because of the emotional fear and the gyrations in the market. So I don't see that as necessarily a hindrance. I see that as an opportunity when it comes along. That's why I don't see it as gambling. And so I'm fine with Christians investing. There may be some certain types of areas that you don't want to invest into, and I think that's fine as well. So, we might call the sin stocks: alcohol, tobacco, gaming. If you want to eliminate those three areas, I typically do, then I think that's fine. There's many companies and many ways to invest that don't touch those three areas or other areas. Or, there may be one particular company you don't like because the programming they put out you think is not good. Well, don't invest in that company then.
On that line, real quick, 2008, yes. 2009.
Yes.
Name a couple companies that fell in the category you just described, that they dipped considerably, but they were still viable, and it was a great place to reinvest, and they did actually survive and now thrive.
Let's choose one. Apple was a great company to invest into. If you look, the stock has, well, I won't go into what splitting is, but basically the stock got down to a low price of around $12 or $13 in 2009. Right now, the stock price is something like $310 a share. So that's a pretty big move for a company that had good earnings and was doing very well. But there's also companies that, there are even companies like, Visa, there's lots of companies that fit that category. I mean, there really are. There are some that didn't. But I mean, you look at some of the big names, Microsoft and Apple, Google, which the parent company is Alphabet. A lot of these companies got cheap and they went up a lot. Now you look at that and you say like, hey, I want to find that next company. Looking back is really great. It's easy to do. Mm-hmm. And so I would encourage you not to do that. And again, that's where the work you have to put into it. If you're going to, you can foray into that. But still, even if you do that work, you don't want to put all your eggs in one basket. And if you're not, find a good growth fund that may have some of those companies in it. You can see what's inside that. Your mutual funds will show what's inside their fund. And you can look at their top 10 holdings. And if you see like Apple, Visa, Microsoft, you can think, oh, this has a lot of technology, and Amazon, things like that. Those are good companies I want to invest into. And you do it with the mutual fund.
Well, Marc, we thank you so much again. This has been Marc Henn with Harvest Financial, our 30-plus year certified financial planner. Not everybody can say that. And so we thank you so much for joining us tonight and sharing all of your wisdom. I hope you all learned something. And if not, you can continue to contact us at the Warehouse OTR, where we can continue to answer your questions. We thank God. Thank you for this time. And
great
remarks.
Tomorrow at 7, we'll have Bible study on the same channel. And so we hope that you will join us.
Thanks, everybody.
All right. Have a good evening. Take care.
Thanks, Marc.
Bye-bye.